It is a quiet day for stock markets as the big, beautiful bill championed by the Trump administration clears its hurdle in the Senate and now heads to the House. We get a little bit of a update from Fed Chair Jerome Powell, and we get some troubling manufacturing data. I'm going to try to make sense of all of it here on Macro Money. This is Ilya Spivak, head of global macro at tastylive. While we have this opportunity before the next big batch of event risk hits the tape, we're going to try and take this step by step and get into how at least one macro-minded trader, this one, would unpack this news flow on a given day. And the main question that we have here, as I can see it, is whether the makeup of what we saw today suggests that the Fed is right to be as worried as it sounds. Because the markets seem to think that the answer is both yes and no, depending on which worry is in question. And how things are positioning then, and what the markets do across major assets, should be majorly influenced by whether the Fed, at least in the market's estimation, is worried about the right thing. So let's take a look at the price action here. First, we have the S&P here down about, that's not correct, it should be 0.09%, because it was nearly flat here on the day, whereas the decline in the NASDAQ really is as big here as it seems, and it's not the biggest decline in the world. There we go, fixed. That's accurate now. And the S&P, for its part, flat on the day after testing near its year-to-date highs. And that's really on the back, seemingly, of this big, beautiful bill situation. Because what we have once we get into the internals sector-wise is outperformance for small caps. The Russell tellingly higher today by a good margin, adding a meaningful 1% today, and the NASDAQ down by almost an equivalent amount, as we say, 0.89% here. And that breakdown seems to sort of broadly reflect the priorities in this bill, and perhaps the expectation that it is likely to get passed. Healthcare up, financials up, consumer staples up, but technology and communication services, sort of looking at the sector breakdown, both down. So this seems to speak to that impact here. Yields, interestingly, a little bit higher at the front end, but still relatively anchored at the back end. Perhaps this reflects the near-term inflationary implications, at least to some extent, of what we saw in this bill. It is expected to increase the deficit by something on the order of $3 trillion. And of course, that's spread out over 10 years. But one sort of more immediate impact here is an update in the state and local tax deductions. This was a big sticking point after the 2017 tax cut program in the first Trump administration that significantly reduced the amount of state and local taxes that could be written off from federal taxes. And this significantly increases the cap from 10, it looks like, to about $40,000. And so a meaningful increase, and that perhaps puts a little bit more money in the hands of consumers, which may be inflationary in that it sort of gives a cash infusion into consumption sometime next year. So maybe we have a lift in the 2-year that sort of follows along those lines, but the 10-year here is still relatively anchored. Crude oil, despite the marginal increase today, still very much in consolidation mode since those geopolitical tensions washed out of the price. Gold a little bit higher, the dollar a little bit lower against its major counterparts. The pop in gold, in particular, interesting here with yields doing what they're doing. Typically, you wouldn't expect gold to do well in an environment where yields are tracking higher, but the sort of story here seems broadly to follow what's been going on in the yields space today. And that's in the wake of comments from Fed Chair Jerome Powell. He spoke at the annual ECB forum in Sintra, Portugal. And it's an interesting story there because what we seem to have today is a very different kind of a story for Fed policy odds than you necessarily have for the broader yield structure. And of course, there's an impact, but that impact seems to be largely downwind for maturities. The message from Powell was not an unfamiliar one. This is basically a rehash of what was said at the testimony last week when Powell testified in Congress, as well as 2 weeks back when he spoke at the press conference after the FOMC policy announcement. The economy is in a good position. If not for inflation risks from tariffs, we might be cutting rates already, but we are expecting, that is, the Fed is expecting to see higher readings for inflation over the summer because of those tariffs. And what the Fed wants to make sure is that we don't then have those inflation readings enter into inflation expectations and then become anchored, which of course would undermine all the progress that the Fed has already made in bringing inflation down. It is, after all, looking at the latest CPI data, just 2.4% at the headline, so less than 0.5% above its target. And the argument here is a familiar one, that with inflation that low and with the unemployment rate at 4.2%, which is historically low, or low by historical standards, not the lowest in history, certainly. We got as low as 3.4% when we were coming out of COVID and there was a mass return to employment. Labor force participation obviously has evolved significantly, but nevertheless, historically, 4.2% is very low for U.S. unemployment. And so, not surprisingly, what Powell is still saying here is there isn't a growth emergency, there isn't an inflation emergency. We have this weird thing with the tariffs that is something of a black box in terms of its impact. It doesn't make sense to jump out the window and make a decision when there isn't a flashing red sign somewhere in the economy compelling you to do it. So what they're going to do is sit on the sidelines, and that's despite the general consensus on the Fed clearly being that rate cuts are appropriate this year, and perhaps most interestingly, Powell saying that he can't say whether July is too soon to consider a cut, which basically means that every meeting is live at this point, though the markets are only pricing in about a 20% chance that the cut actually happens in July, and we'll take a look at that momentarily. On the data front, we have a slightly better than expected reading on the manufacturing side of June's ISM economic activity surveys. This is basically another version of PMI. The headline PMI numbers, of course, coming from S&P Global. That's sort of the biggest provider of PMI data for most of the world's countries. Some countries have more than one set of these numbers from different providers. China has that, and so does the US. The Institute of Supply Management is a very long-running survey on this and very closely watched. And what we see here is that the manufacturing sector remains in contraction mode here, as ever this is done in the logic of PMIs. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So what you have here is a fourth consecutive month here below 50, and that suggests that whatever pop you had in manufacturing in January and February, that's this right here, where you crossed back over 50 into positive territory, ostensibly around the front running of tariffs, that is increasingly spent, and we're back into a contracting mode here. But it is the internals of this data that really grab attention and give the Fed chair some coverage in what he is saying, because what we have here, there's the 4 months of contraction here, readings sub 50 in the yellow bars. But when you look at the internals, the price component is surging. This is in fact the fastest price growth that we've seen in 3 years, going back to the middle of 2022. And it's happening at a time when that price growth isn't being motivated by economic activity in the sector, clearly, because not only is overall activity actually shrinking, but we can see here employment down. Fastest contraction in employment in 3 months. New orders down. Fastest contraction in new orders in some time. So what we're looking at here is an inflationary shock, not demand pull inflation. That is to say, more people want output, and so they compete on price, and the price goes up. That is not what this is. This looks like the kind of stagflationary risk, or at least stagflationary dynamics, certainly not stagflation economy wide, but the kind of stagflation dynamics that the Fed is worried about. And indeed, we saw 2 weeks ago from their summary of economic projections, they're downgrading expectations for growth, they're increasing expectations for the unemployment rate, they're increasing expectations for inflation. And so that's exactly what this ISM data seems to imply. But of course, the big disparity continues to be what to do on rates. The Fed seems to think that we're going to have this kind of shock here where growth veers in a worse direction, inflation veers in a higher direction, but ultimately things settle relatively in the longer run. And what this inflationary shock ends up meaning is that the Fed can cut less because they don't want to let inflation out of the bag as this washes through the economy and becomes what the Fed hopes will be a one-off, a transitory influence, as it were. And so what we have is a downgrade in rate cut expectations for 2026 and 2027, where before we were going to get 50 basis points this year and next. Now we're looking, and then a 25 basis point cut in 2027. Now the timeline is extended. We only get one cut next year and one cut in 2027. That, of course, is not at all endorsed by the markets. So here's 50 basis points right here. The markets, for the most part, are where the Fed is there. They have 58 basis points for this year. So they're only a bit over where the Fed is. And indeed, if you look at the disparity here, there is about a 32% chance, 8 basis points out of 25, that you're going to get a third cut. But 32% is not nothing. But it does suggest that the Fed is broadly in line with markets, at least for this year. For next year, though, it's a completely different story. The market has 68 basis points on the menu. That is to say, it's fully baked in 50 basis points in cuts. So that would give you the full 2 cuts there. And in setting it at 68 basis points, it suggests that we are a very good way to getting now to 3 cuts next year. So 68 basis points is 18 on the way to a third 25 basis point cut. So the probability of that third cut next year relatively elevated now at 72%. Now, if the Fed is saying 1 cut next year and the market is saying 2 and a 72% chance of a third, that's an entirely different kind of perception on what is likely to happen. Indeed, if we take a look at even this year's trajectory, we can see that since the Fed basically made the case for all of this with June's policy announcement and issued that summary of economic projections that we just saw, since then, the path even for this year has become more dovish, even as the Fed has said all of the same things. We can see the curve here has actually edged down. Now, that gives us the first rate cut in September, second cut somewhere here in October, December, with a fairly decent shot, even at a third by December. But as we saw here, the trajectory is still favorable of 2. So what is it that the markets are seeing here? Why are they so much more dovish than what the Fed is saying, even as the Fed keeps saying the same things over and over and over again? And we get back to this idea that from the market's perspective, the Fed is wrong to be worried about inflation risk. When we look at what this begins looking like at the beginning of the year, here's the S&P 500 in the yellow. It is falling alongside the bond market's measure of expected inflation. These break-even rates are the difference between nominal and real interest rates, so nominal yields and TIPS yields, that extracts the inflation adjustment that it would take you to get from nominal to real. Obviously, nominal rates minus expected inflation is what gives you TIPS yields. So if you take the difference between nominal and TIPS interest rates, the magnitude of that inflation adjustment is what you're left with. So you can see that these inflation expectations in the bond market were falling with stocks from about mid-February and until the beginning of April, around the idea that the tariff rollout as it was happening would be negative for economic growth. And of course, when you have that kind of influence, as positive economic growth would boost inflation through demand pull dynamics, here you'd have demand destruction, and so lower inflation, less upside pressure from demand on prices, which is exactly what you see here. Then, of course, we get the Liberation Day back and forth, and clearly sentiment recovers here. The S&P 500 is back to where it was pretty much at the start of the year, but inflation expectations have not followed. In fact, the nearer term 5-year here is basically where it was at April's lows. And so the market is saying here, the bond market, we have a growth scare that hasn't gone anywhere, still very much on the books. Just because stocks have rebounded doesn't mean that it's anything different here in terms of growth dynamics, which is why ostensibly they want all of this easing. Because while the Fed is worried about the tariff risk, the market obviously is not. And it's saying the Fed needs to cut to underpin growth. To that end, we can see here the Atlanta Fed's GDP growth now model. And never mind whether it's actually right about where second quarter GDP is headed. That's ultimately not important. We're far enough away from those numbers that this model is going to change quite significantly between now and then. More importantly, what this model is a distillation of incoming economic data as it appears. And by the way, the ISM numbers from earlier today are now in this model. So what we see here is the tone of the data going into the model since about mid-May has been clearly negative. And so the way the wind is blowing, as it were, for the U.S. economy is toward weakness. We see the same thing from the economic surprise index data that Citigroup puts out. We can see the U.S. is clearly the weaker hand here across the major economies. In the blue here, if you squint, is the global reading. It's been heading lower, and we can see that it's been heading lower because of what's going on in the G10 economies as emerging markets hold up here. And we also see that whatever's happening in these G10 economies isn't happening because of Europe, which we can see is holding pretty well here as well. So clearly, it is the U.S. that is now the main drag on the tone of global economic data. And this, of course, tells the same story. So what we find today, then, is a manufacturing survey that generally tells us the Fed is right to be worried about what is happening here with prices and with demand diverging in an adverse way. And so in that sense, what it's saying here makes sense. But also that the markets are looking through inflation and saying the impact on prices will ultimately register not as sequencing, where first you get the prices, then you get the hit to growth. No, the markets are going to be focused on the growth, which is already coming undone. And that beckons rate cuts because inflation is going to get pushed lower by the demand destruction of an economic downturn. And how this gets resolved and which way it gets resolved ought to be very impactful. The dollar, of course, has been falling with this deterioration in the Fed policy outlook, and stocks seem like this rise was built primarily on sentiment, but certainly not invulnerable to growth concerns when they become acute. And so, with that in mind, there is perhaps a vulnerability for stocks to come in and for the dollar to rebound if this starts to shift this way or that. With that, we're going to be watching out for the next layer of this ISM data that's coming later in the week for the all-important service sector. And then, of course, the U.S. jobs report as well, which we're going to focus on in depth tomorrow when Macro Money returns, as it always does, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close. In just 30 minutes' time, I'll be on, as I am every Tuesday, with Victor Jones for The Price of Truth, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Happy trading. Macro Money will be back.